Welcome to the live stream. It is Tuesday, August 12th. The market has closed for a couple of hours, and it was a glorious emerald day on Wall Street with a lot of stocks going up and some big ones going up. Microsoft up 1.43, Broadcom up almost 3%, Meta 3.15%. These are big caps. These really make the market move. What also went up is the Russell 2000 small caps. That looked really good. Even healthcare had a little bit of a bright spot. United Healthcare up 3.65, and I'm keeping a close eye on United Healthcare. Is this the beginning of the comeback for United Healthcare? I hope it is. I really hope it is. And we had stocks in a variety of places do well today. So it was a really good broad-based rally. What kicked this thing off was the expectation that we're going to have lower interest rates, which was driven by the inflation report that was announced. Inflation is not out of control. It actually ticked down. So if inflation's under control, it's expected now, it's pretty much locked in that we're going to have a rate cut in September. And the market, from what I heard, is pricing in a rate cut in September and a following rate cut in 2025. So the market liked that news overall, and it moved the market. Man, did it move it. We've had 3 weeks of earnings, and now we've had more earnings this week, some smaller companies. I thought it'd be interesting to take a look at those companies. Now, this channel, if you're new to it, I'm a long-term investor. Valuations matter to me. It's not just, hey, stocks go up because they're supposed to go up. They go up because they sounds like a cool company. No, that's not how I invest. I look at each entity as a profit generating entity, a free cash flow generating entity. If they don't generate cash flow, it's going to be tough to value them. So as we look at companies, I'm going to take that type of approach and look at these companies through the lens of the valuations of these companies, doing deep dives on companies to try to understand how valuable will these businesses be. If you study the most valuable companies on the stock market, they all consistently have revenue growth, free cash flow, profits, and solid balance sheets, with no exception. Look at the top 10, no exception. That's how those businesses got to such high value, is because they drive free cash flow. They are profitable. They have very high gross margins. All those things are in place. So as we go away from the big caps and look at small caps, those principles are not removed. I still look at small caps through the same lens. Do they produce profits? Do they have high gross margins? Do they have high revenue growth? Do they have the ability to increase the free cash flow in the future? All those things is what I really focus on. So when we look at stocks, that'll be my focus. You want to look at a stock? I'd love to look at it. The rules of engagement, if you're a member, paid member, it's just included with your membership. Just put a ticker in the chat. We will take a look. We will do a deep dive. Not a member, want me to do a super chat? Want me to do an analysis on a stock? A $5 super chat is what it'll cost. So let me know. Love to get into stocks because I want to talk about the stocks you want to talk about. In the meantime, let me kind of cruise around and just see what the market did today. So overall, the Dow went up 1.1%. The S&P up 1.13, NASDAQ 1.39, and then Russell was up 3%. Small caps will rally much better in low interest rate environments. If interest rates are really low, then small caps are going to flourish. If you recall, back in 2021, we had a really low inflation, really low interest rate environment, and small caps did great. Other news, Bitcoin is at $119,905 per coin. I looked at it half hour ago and it was at $120,000 a coin. I thought I was going to be able to flash that up there and go, hey, look at that. But it's not. It looks like we've got a community member. You want to look at AIoT. We're going to look at that first. Thanks for joining and thanks for your support of the channel. I really appreciate it. And I want to say that the handle, is it triceps Brocky? Hopefully I didn't butcher that. But we're going to look at your symbol. That'll be the first one out of the gate. All right, cool. So we've got a stock to work on. I've got some stocks. I'm going to give you the kind of like the earnings list. We're going to look at C Limited, Core Weave, Circle, and I think Intap. So those are the ones we're going to look at. But first, we are going to look at AIoT. So AIoT is Powerfleet Incorporated. And these guys were up 5.92%. They announced yesterday. Year to date, the company's down 30%. The 1 year, even. 5 year, down. What do these guys do? It's a really small cap. All right. Powerfleet provides artificial intelligence of things. So it used to be called IoT, Internet of Things. I guess now they put the A in front of it. In North America, Israel, Africa, Europe, Middle East, Australia, and internationally. Its Unity solution portfolio includes a Unity platform that enables integration with Internet of Things devices, third-party business systems, to a data highway that powers artificial intelligence-driven insights to help customers save lives, time, money. Okay. So we live in a connected world. Obviously, we're talking because we connected on the internet. We're on a live stream. You're either watching it on YouTube, X, or Facebook. Well, devices are now connected. These devices are connected all over the world. And these guys are saying that, hey, we are going to be a player as we see all these devices connected. So that makes sense to me. Let's take a look at their website just to see if we can get a visual on what we're talking about here. So this is Powerfleet. All right. Solutions. Let's take a look. So we've got the Unity platform. Okay. Fleet management. So this might be for like if you have trucks, if let's say you have a company operates delivery trucks, or maybe you have a fleet of whatever, vehicles, vans that are delivering packages and that type of thing. Or you have service technicians that are going out to service medical equipment or whatever equipment they're servicing. That truck could be connected to the internet, and the business could look at their assets wherever they're at, maybe even monitor some information from those assets. So we got, okay, so, all right. So you have vehicle telematics. So you're seeing what that vehicle is doing. All right. Material handling. All right. So you're seeing equipment that's out there. Maybe you have a big yard that is moving a lot of inventory and so forth. You can track that. Okay. So they're doing video cams, asset tracking, container. Okay. So these are things that kind of make sense. Internet of Things. The industries they support: construction, distribution, and warehousing. That makes sense. Leasing and car rental totally makes sense. If you connect these like a car rental company, they'll always know where their cars are at any one time. Somebody wanted to know, where is that, Toyota Camry that we rented out. You can track where it's at. Field services. Yep. That makes sense. So if you have a business that's doing service for the airlines, electricians, roofing, that makes sense. Okay. So I understand what they do. This is not a foreign concept to me. I've worked in software and understand Internet of Things. This solution makes sense to me. All right. So it's a small cap. I really like small caps because small caps can double, triple, quadruple my money really fast. So let's see where this one's going to land from a valuation standpoint. So as mentioned, year to date, they're not doing so hot. Today they had a good day after their earnings. We're going to examine their earnings in a little bit. In fact, let's get that ready here. Let's see here about us, investor relations. Let's see. So okay, we'll take a look at that in a little bit. So $615 million market cap, revenues 391. They're operating with a loss, not a showstopper. We're going to take a look at cash flow generation in a bit. Analysts are really bullish on this stock, but let's take a closer look. So they are growing. Holy smokes, they're growing. So they're growing big time. What's going on? Yeah, they're growing really fast. So Q1, so they grew at 38%. That's still really good. But they pretty much have doubled. In the trailing 12 months, they've grown 119%. That's really impressive. You don't find that kind of growth all that often. Even though this is a small company, it's pretty darn good growth. All right, so this is going to have margins at around 60 to 65% gross margins. Let's take a close look. So I'm going to look at gross margins, right? So 55%. Now, as this company gets bigger, their gross margins are going to get bigger as well, broader, because of their scale. Right now, they're fairly small, so they're going to, as they get bigger, I think that gross margin is going to get better. They are making operating margin right now. That looks pretty decent. Then free cash flow. So let's take a look at how cash flow has been trending. So they've kind of been, the good news is they're not burning a lot of cash. That's really good. But they're not producing free cash flow yet. Okay. Let's take a look at the quarterly, and then we're going to look at the cash flow statement. So the quarterly has slightly negative quarter on free cash flow. The quarter before that, Q4, was 10 million to the upside. Negative. Okay. All right. So let me take a look at their actual financials. It'll kind of tell me, what are they spending their cash on? So here is I think the deck they presented yesterday. This is for the Q1 fiscal 2026. Good. That is correct, right? Yeah, Q1, which ended June 30th. All right, so and I'm reading this, kind of scanning. This is a kind of a software play. When you see ARR as annual renewable revenue, that's good. That means it's sticky business. These types of customers tend to take on a service of this type, and they keep it for a long time. So that's good. I like sticky businesses that they get to keep the customer for a long time. These are some of their big wins. Looks like they got a Fortune 500 manufacturing leader signed a deal for $750,000 total contract value. And then this is an agriculture company, $700,000 total contract value. So they're getting some chunky deals. Nice deal. Very good. So is this company in Africa? How interesting. I just want to take a peek at that. So no, United States. I guess just they really like them in Africa. Is that point. Okay, good. That would have been cool. All right. So this is car rental company is going to use their equipment, their service. Here's a equipment company, Wholesome Global, and I know that Shadow Guy, he liked Wholesome. Looks like they're coming up here. This is a company that does building materials. So, okay. Okay, this makes sense. They're tracking vehicles and they connect to these systems that companies use. This is ERP is enterprise resource planning, transportation management systems, customer relationship management, warehouse inventory, warehouse management systems. So they want to integrate with those because they're going to connect machines, and those machines are going to communicate with the enterprise software systems that are being run here. Okay. They could also, it looks like they're tracking, like if you have these drivers, you can track their safety. Are they driving within the speed limit? Are they doing things right? So that's another reason why a company would want to have these types of devices so they can track their trucks. All right. So the growth is good. Okay. I give them that part. I'm just trying to get my head around their profitability. So their EBITDA, this is earnings before interest, taxes, depreciation, and amortization. It's really growing nicely. That's good. That's about 7. So that's really good growth. Good job. Revenue is growing nicely. So you see how they make a lot more money on services. When they sell their product, it brings down the gross margin. So that's good. That's good that they break it out. All right. So okay. And I'm reading as I'm going through these slides, trying to get my head around their business. Yeah, I like this slide. All the things connected. All right. So they didn't show me financials, but I bet you we can find those if we go here. Let's see if we are going to be able to get to a nice schedule based here we go. So here's the PDF. Here's the 10Q. Let me try this guy. Okay. So we kind of reviewed this. And they do have financials here. So here are revenues. Most of it is services. Very good. Because they were saying that services, they have a much better margin, like mid 70s, 75%. On product, it was like 30%. So they're selling more services. It's very good. And I know it's really little. So let me try to make that a little bigger for you guys. There we go. That's a little better. So they're selling mostly services. That's good. So that's total revenues, gross profit. So here's your selling. Okay. All right. So they're pretty close to being profitable. That's good. And their selling expense, if you see from 24 to 25, their overall selling, general, and administrative expenses, they actually went down a little bit. That's good. That's good. If they can keep it like that, that'll be very, very good. They have some research and development expenses. Understood. If they're going to be a technology company, that's just expected. All right. So they have a little bit of cash, about 35 and some change, 35 million. Okay. And how much debt do they have? They do have some debt, 232. Now, when you see interest rates go down, like the expectation we have right now, It helps business like this because if interest rates go down, these guys can redo their debt and get a lower interest rate. It's like your house. If you saw lower rates, hey, I'm going to refinance and get a lower rate and lower my payment. Same thing for these guys. So you see, as interest rates are expecting to go down, these small caps are beginning to rally. That's one of the reasons. All right, cash flow. So they lost a little bit of money, understood. And then we've got depreciation and amortization. Okay. That gets added back to the overall statement of cash flows. Now we have some negative numbers. So deferred income taxes, looks like they were not able to defer income taxes. That was a negative. They are carrying more inventory because they have that product. No, that's accounts receivable, excuse me. Accounts receivable going up means their customers owe more money. They're carrying more inventory. All right. And they are getting bigger. So it's understandable that these have to go up because they just have to have more in inventory to service a bigger business. Prepaid expenses. Okay. All right. That all looks fine. They did catch a break on accounts payable. That means that their accounts payable went up. So they had a positive $4.7 million of cash from operations. They have CapEx, capital expenditures, and then capitalized software development cost. These are collectively 11.8 million. So they have negative $7 million of cash. Okay. All right. So this business is headed in the right direction. I think as they scale up and they start turning a profit, and their business, just especially on the services side, as they sell more services, they're going to get more profitable revenue into the business. And this cash flow statement is going to turn positive. Okay, so we're not going to be able to value this business based on free cash flows, but let's see how many analysts are covering this stock. 4 analysts. Okay. What's the backgrounds of these analysts? So we have a pretty legit analyst here. And it looks like the same person gave him multiple ratings. Okay. All right. They all think this stock's worth a lot more. It is. These lower price stocks, like $4.65, it's unfortunate that they're priced this way because that removes confidence from investors. I think investors are cautious when it's a low price stock like this. They think, whoa, how did it get this low? Why is it that low? Some analysts think it can get up to $15 per share. Another one thinks the lowest point is the worst price target is $8. Okay. Now they're expecting that the business is going to keep growing quite nicely. It's going to be a $500 million revenue company. They are going to be profitable, and they're already in the 2026 year. Okay. That looks good. So this stock, looking at what it's done for the year to date, it's down in the 1 year. Okay. So this one's a little tricky because I'm trying to see how I can forecast their free cash flows. And it looks like they're growing at 38%. They have combined gross margins of 54%. So let me try to work with that. I'm going to open up their financials in a screen you guys can't see, and then I'm going to update a valuation schedule on these guys. We'll try to make sense of Powerfleet. So this is how, whether the company is big or small, the reason that I would invest in Powerfleet is my expectation that they're going to produce revenue growth, profit, free cash flow. Now, at this point, I want to take a logical, conservative approach at determining what their forecast is going to look like. That's the approach I'm going to take. I'm going to use a schedule that I use on companies like this. I'm going to use, wonder if I have Cisco in here. Yeah, cool. So Cisco is both a hardware and software company. So is Arista. A lot of people like their cybersecurity business, but at one time they were a networking company and they converted to mostly services because there's more money in it. Can't blame them for doing that. Okay, so we're going to copy Cisco, put it down here so we can work on Powerfleet. All right, so Powerfleet is going to have a higher discount rate. As a company becomes riskier, I increase the discount rate so I can be compensated for my risk. I'm going to go to 12. So the free cash flow, and this is going to be an estimate. So they were negative 7%. They were negative $7 million in free cash flow, excuse me. But they're growing at 38%. And what I want to do is I want to take their gross margin and maybe take half of that, which would be 38% times their current business, which is, so they're a $391 million business. So if we take that, so I'm going to take half of that. That's 196. Now, half of that is in essence, no, I didn't do that right. So times, and their margin was 55% times 0.55. And then times 0.5. 0.5 being that there'll be a, so that's their gross margin, and not 0.5. Let's say that they're going to keep about 25% of that as free cash flow. So they'd basically cash flow over the next 12 months, potentially $54 million. Okay. That's just kind of a rational, okay, they're going to grow. I still didn't do it right. Okay. Sorry, guys. I have to do the math right. So they're going to grow this number by 30, I'm going to call it 30% to be conservative. And then based on that 30% growth, okay, so they'd be at $16 million of free cash this year. That seems about right because they're just barely starting to go free cash flow positive. They're growing at a high rate. So if they're growing at 38% and they're small and it seems like they're succeeding, they're getting some really good customers, I'm going to grow that number by 25%. And they're a small business, so they're going to grow the long-term growth by 5%. This is at a 12% discount rate. And part of the reason there is that they do carry some debt, right? When we look at their debt, if it's a small business and they don't have debt, that's way better. But they're carrying a pretty good number of debt, $283 million. That's a liability, a pretty good one too. So you got to be careful with companies like that. You know, we can like companies because they've got a really good solution, but we got to be careful with this debt. Debt can take a company that has a terrific idea and just ruin it because they're, it's in essence just working to pay off this debt, and that's really bad. So right now I'm not getting there on their valuation. Let me double check the shares outstanding. Shares outstanding 132. That looks correct. So right now this one is just it's a little too young. If they can show us a little bit better cash flow, I give them a better cash forecast. Right now I can't get there on the valuation. If we look at their forecast for earnings, it's not going to be great either because it's just a couple of pennies. It's going to be 8 cents per share. And they're a high growth company, so 36. And then they're going to grow that nicely by like 100%. So you can value the company based on their earnings per share. It's discounted by 19%. But it's going to be, I think they will eventually produce free cash flow. But I can't get there, with the line of sight of how they're producing the free cash flow right now. So this is a pretty conservative forecast. If we lowered the discount rate to, let's say, 10%, it would improve the valuation quite a bit, but I'm still falling short. And this is 16 million. Yeah, that's correct. So that's as close as I can get. For me, I think this is a really good watch stock, but I don't know that I'd be a buyer because it's just too early. For all we know, things aren't going to go their way. And a lot of investors are getting out because they're getting, cold feet. They just announced. I would give it another earnings release or two, get some more data, and be able to value the stock more closely. Or I should say, if their fundamentals improve and we start seeing some really good cash flow, come in, that would really improve their valuation. For now, this one, I think they have a really good idea. I think it's good stock to watch, but that's about it. That's all I would be willing to do. I have to have a valuation before I proceed. And I like staying in that lane. That way I know that, hey, I'm expecting this company to do well. I think they are going to do well. I'm growing their free cash flow nicely for them. I think eventually, this makes sense. It's a little conservative, but this is likely what's going to happen in their statement of cash flows. So thanks for asking about this one. I think it's a good business. It's a neat business, and it's worth tracking. But when you follow a stock, it doesn't cost you anything to follow a stock. It does cost you money if you buy into a stock. If you buy into a stock and then you find out, oh no, I've been surprised, then it costs you money. So to watch a stock doesn't cost any money. So thanks for asking about AIoT. We're talking about this stock. I think Michael Anthony, that's the stock we're talking about. A really small cap. I'm glad you brought it up. I like small caps. I think right now the market's really expensive, but small caps have not been bid up as much as the big major caps. So we got to do our homework, pick the right ones, pick the ones that are going to, really perform well and go with them. So thank you very much for asking. And hopefully you found my analysis interesting. Eric Johnson. I did not sell my A-Lab stock. I'm hanging on. I've got my seatbelt on. And the roller coaster ride is still really fun. It has taken off. And I'm just hanging on. 262 performance since April. Really, really good. This stock we found on a live stream. So I can thank somebody roughly 5 months ago for pointing this one out. We followed it. And this is an example for AIoT. We followed it because it was too expensive. It had just jumped up way too fast. And it was like, wait, we should have looked at this stock in the middle of 2024. And then the market gave us a really nice gift. It knocked on my door and I answered. And it said, hey, I'm willing to sell you Astera Labs shares now at a much lower price, close to $50 a share. And I said, thank you very much. It's like your DoorDash delivery comes in, you give them a $20 tip, you're so happy. And from that point on, boy, it's just been a really fun ride. Now, I've considered selling some shares, and I haven't. Doesn't mean I'm not going to, but I'm just letting it ride, and may sell, I don't know, 25% of the shares that I own and just take the gain. And probably at 25% of the shares that I own, I'll be close to having somewhat of a zero cost basis. Just the shares that I'll own will be nearly costing me nothing based on the gain that I take. So we'll see. We'll see. Thanks for asking about Astera Labs. Shadow Guy. Oklo just released earnings. Really? You know who brought this stock up is Daryl. Daryl's an investor in this stock. So they went up 9%. Go Daryl. Oh, they're down over the 5-day, but they really jumped up. This is Oklahoma. Oh, wait. I'm thinking of a different company. Yeah, I'm totally off. Okay, sorry about that. So Oklo Inc. is an advanced nuclear technology company based in Santa Clara, California, founded in 2013 by Jacob DeWitt and Caroline Cochran, both graduates of Massachusetts Institute of Technology. Okay. So what do these guys do? Clean, safe, affordable energy. Sam Altman was involved. Wow. Holy smokes. Yeah, now I remember. I think Shadow Guy, you brought this one up. Jeez, look at that. Incredible. So they announced earnings, and what is the story here? What's going on? Okay. LO. So I get that there's a need for power. I get that. How much power is this company producing? So they're not producing any revenues yet. It's just all losses, I think. So selling administrative expenses. So this company is getting their ideas together, probably designing how they're going to generate power. And this is a speculative investment where if you invest in this, you're expecting these guys are going to pull it off. They're going to be successful in it. And maybe they do. Maybe they're able to. But the stock's been really going up. They're up to 11.5 billion. That's a pretty pricey endeavor. And what are they going to use for? They're going to use nuclear. Okay. It's going to be a while before they produce revenues. Not my kind of, not my investment for a couple reasons. I like investing in things that I understand. I know what nuclear power is, but I don't understand it. I don't understand what's really important about it, or what has to happen in order for a company to successfully produce nuclear power. I don't know any of that. Margins. If you look at utility companies, the margins are terrible, but we can't tell because they don't even produce revenue. So this one here, this is somebody else's investment. I'm not trying to, hit a grand slam with a stock like this. No, I need to see enough evidence where I'm seeing that for the next 5 years, they have a really good opportunity to do great. This one here, to those that invested, congratulations. Really, really excellent appreciation. So, but I can't value them because they don't have revenue. All right. So looks like, so Shadow Guy, and that's right up your alley, Shadow Guy. I think you can understand nuclear power far better than I can. And I would read their earnings announcement and kind of understand, what is their idea and how are they going to make that idea work? And then how are they going to commercialize everything? That would be really interesting. So good luck with that. Thanks for bringing it up. Great to see you. David Knight. Yeah, Catalyst Pharma has been selling off, and what did it do? So it did okay today, and year to date, it's down 2.54. It did sell off quite a bit after having a nice little run. It sold off quite drastically. They had an earnings where revenue did under impress. They still grew, but they just didn't grow fast enough. The market wanted them to grow faster. You see that they were growing at high rates, and then they came down to 19.44. Their drugs are still good. They have two principal drugs, and those they continue to have demand. So I'm actually buying shares of CPRX, so I'm good with the discount, and I'll continue to own that stock. Michael Anthony, how you doing, man? Yeah, yeah, love the ride. Yep, on ALAB. So, do I have an ideal range of stocks to shoot for? The answer is no. I have, I don't know, 40, like low 40 stocks. Now, probably the top six stocks are like 80, 90% of the value of my portfolio. And then from there, I buy stocks that look really interesting, like A Lab or Robinhood. I bought, and it's really gone places. And you for me, I like continuing to look for another stock that's really going to work. Did a video for members and released it today on material stocks, and they're beginning to really work. And that's the part of my portfolio where I get to kind of tinker with stocks and try to find something that's going to really perform in 2025, 2026. So I don't have a set number. It's not like, oh, this is the perfect recipe. Nope. I think I have a high interest in all the stocks that I own, some more than others. Some are huge positions and some are very small positions. Right. So Michael Anthony, what happened on Lyft? So Lyft, Uber won that war. And Lyft is just kind of hanging around. I think you can. The only reason I would own Lyft is short-term gain. Like I see that, hey, they are discounted. I could show you that they're discounted, but it's not going to be a long-term winner. Uber won the war. Uber is so much bigger, and these guys 15 years ago were relatively similar in size, but Uber just outperformed these guys. All right. So looks like Tricep CRMD. CRMD. Core Medics. All right. Another small cap. Up 14%. Up 42% for the year to date. Up 200% for the 1 year. The 5 year doesn't look as pretty, but the 1 year looks rather beautiful. Really high volatility. Not a big surprise. It's a small cap. $858 million of market cap. Revenues at 121 million. So you're paying about 6 times, 7 times revenue. They have a PE ratio, really low PE, strong buy 46%. What do these guys do? CorMedix is a biopharmaceutical company focused on developing and commercializing therapeutic products for life-threatening diseases and conditions in the United States. Its lead product, Candid Defancath, an antimicrobial catheter lock solution to reduce the incidence of catheter-related bloodstream infections in adult patients with kidney failure. Okay. So they do a med device. Okay. So where's the product? Show us a picture of the product. So they're not showing us the exact product. Okay. So if we're talking about catheters and catheters that are going to reduce the risk of infection, I'm thinking of a med device of some sort. Let's take a look at their margins and let's take a look at their financials. And part of that will be margins. I'll tell you if it's a pharmaceutical or a med device company based on margins. All right. So these guys are just beginning to crank out revenue. The revenue growth is good. All right. So they are getting into the commercial stage of their company. 39.74 million is their revenue. Wow, their cost of revenue is really low. Looks really good. So their gross margins are going to be really good. 95%. Nice. Wow, they already cash flow too. This looks really good. Now, in healthcare and healthcare pharma, biotech, I'm seeing a lot of discounted stocks, and it seems like healthcare just is not getting a lot of love. AI is getting a lot of love. Even crypto is getting love, but healthcare, here or there, you see some stocks really flourish. This one's flourishing, and this one has really good fundamentals. So this one's at $30 million of free cash flow in the trailing 12 months. It's growing nicely. The margins are terrific. Okay. So I'm going to look at their I want to see their earnings, and I want to see if they're guiding and they tell us how they're going to grow. So let's see here, investors. So this was released on August 7th, 2025. They acquired another company. Okay. We're going to look at their balance sheet after we get through this earnings release. Okay. So they didn't guide. I didn't see a guidance there. So this is the second quarter, the quarter they just released. Okay. All right. So big increase in revenue. We kind of knew that. And they have a lot of cash. $181 million of cash. Looks good. And accumulated deficit. They don't have any long-term debt. So that's good. They have a lot of cash, no debt. Very good. Then here's their cash flow. And they're not breaking out the see right here is where we can get our CapEx number in the section that says net cash used or provided in investing activities. They give us a lump sum there. So the cash from operations is very good. So they're probably doing more like $40 million of free cash flow. Okay. So $40 million of free cash flow. They didn't guide. So let's go back to stock analysis. Six analysts cover the stock. And the best price target, $20. Worst one is $12. So looks pretty good. These guys are saying this company is going to double in size by the end of the year. Okay. And, or I should say there'll be 164 million. And then they're going to grow up 45% and then 17%. That's very good. So if they're $40 million in free cash flow, they're very high margin business. You can go 30 times free cash flow, and that's going to be roughly 1.2 billion is plus cash, which is like another 100 million. So this stock is discounted by, I'm going to say 20 to 30%. It looks like a good stock. I just want to just put it out there. Healthcare stocks, you can find, this one here is really, really good. You can find a lot of discounted stocks in healthcare. They're just not getting the amount of attention that you would think they'd be getting. Now, this one here for the year to date had a really nice run coming out of April, along with a lot of stocks. And then it really pulled back over the last month, just barely back to even. And had a really good day today. Was there news today? Nope, no news today. So it was up 14%. Wow, that's really good. This one's also a really good watch stock. I probably have like 10 stocks in healthcare that are all discounted. This one looks really good. Let's do a quick valuation on it. This one will be a little bit quicker because it's already got numbers, and I don't have to use my imagination. So CRMD, CorMedix. All right. So I know you're a member, and I'm going to update this is all part of my research, and I update it to the shared folder for members. The update will happen this weekend coming up, and then you'll get the valuation of AIoT that you asked for, and then you'll have the valuation for CRMD. All right, so I'm going to compare this guy to United Therapeutics. This is a nice company. It's discounted. It's a real neat healthcare company. And all right, so today's date is the 12th. All right, so my discount rate, these guys are smaller than United Therapeutics, so I'm going to go to 10. Now, the free cash flow, they have a $40 million run rate, so I'm going to go with 40 million plus their growth. So they are growing really nice. So their growth rate, I'm going to grow that cash by 30% and then 5% after that because they're small. They'll probably grow for a while. And it's Be 40. So 52. So we get intrinsic value of 1.7 billion, and they had cash on their balance sheet. So stock analysis is giving me numbers that I thought were different on their financials. Let's take a look at this again. Go to the SEC filings. What's good about SEC filings is companies have to report using a format and a consistency that is generally accepted by accountants. So you can't like play around with it and write it your own particular way. No, you have to write it the way that most accountants would write it. So they have 181 million in cash. Okay. So 181 million. Okay. Do they have debt? So they have accounts payable. They don't. And stock analysis is saying they have $435 million of debt. So that's why you always want to, you want to go to the financial statements the company produces, because sometimes stock analysis is a really good website. They don't pay me anything. I have no reason to, kind of defend them or anything, but they aggregate so much data. They have these algorithms that aggregate the data, and sometimes the data's wrong. Well, it's my money, and I'm going to go verify everything based on financial statements. And there's an example of why we ought to be doing that. Okay, so revenues look great. That was fine. Let's see if the statement of cash flows is even better than this one's way better. See, they have cash flow that's even better. That summary they provided on their earnings release was kind of terrible. So 49.7 is going to be the free cash flow rate. So we can update that number. So that's going to be, just go with 49. All right. So that looks good. No debt. Now, make sure I've got my shares outstanding correct. So shares outstanding 74.65. So the cash flow is really going to look good for this company. Now let's look at earnings per share. And I'm going to go with earnings per share from, I think this number will support it. I'm going to use 2025 numbers. It's a growing business. They're going to grow that quite nicely in the future. Yeah, this looks really good from a fundamental perspective. So the fundamentals are there. Now, I would do my homework on this company and understand, is their product in really high demand? Is it really solving a problem? If those things check out, I mean, you've got a discounted stock. It's pretty darn discounted. If they come through and start cranking out this cash, the market will have no choice but to start paying attention to them. So this is a good one. You're 2 for 2, my man. Very good. And again, you will have the valuation I just created, because I store all these and then I put them into the shared folder for paid members. You'll have this detail, my research on that valuation this weekend. If you have any questions in between now and then, feel free to ask. But this one here is discounted. It has good growth. It's new. It's a tiny market cap. So it looks good. I'm just, man, healthcare has just been like hard to invest in because a lot of healthcare stocks have not received a lot of love from the market. In the near term, the hey Juicy, what's up, man? Well, your handle, I have too many members now and I can't remember who's who, but of course, very good to see you, man. And two really good stocks. So where I was at was healthcare stocks. They're not receiving a lot of love. There's a lot of stocks that I have that I've reviewed that are discounted, and I'm watching them. And I think with lower interest rates, I think that's going to help. And I think some money's going to rotate from AI tech into something else, and that something else may be healthcare. But man, I've been thinking that for about a year. And we'll see when it happens. I hope it happens. Thanks for asking, Juicy. I'll try to remember your handle. Okay, so Michael Anthony. Yeah, Pfizer looks good, but it's kind of Pfizer is good for I'm going to say just an older investor that just wants kind of stability and income from a dividend. If you're looking for, hey, I'd like to find a couple of stocks that are just going to take my money and multiply it times 3 over the next, 3-4 years, you're going to have to take chances with small caps and outside of Pfizer. And Pfizer hasn't been, a great experience for investors over the last couple of years. But it depends what you want out of a stock. If you're an older investor, you want stability. Yeah, Pfizer and some other pharma stocks are looking pretty darn good. Even Novo Nordisk is looking really good. But the smaller caps like Catalyst, I'm doing well with, even though it's down a little bit. I'm still doing really well with it. And I'd like to have a nice set of biotech companies that are going to really, really deliver some great returns. Right, David Knight. So you're heavy in AMD, Micron, Elf, and Uber. Cool, man. Good luck. I own Uber. I'm glad I own Uber. And is Sezzle a buy yet? Sezzle, I put it on my watch list, huh? Nope. So, yeah, it doesn't ring a bell, but maybe I reviewed it and just didn't save it on my watch list. Did I put CRMD? Yeah, put it on there. I'll come back and fill this in later. All right. So Michael Anthony, why has CRMD been selling off, then only bounced today? Well, I think with small caps, not a lot of investors are tracking tiny caps. And as soon as they get some attention, they might start rising. And especially if they start to rise and catch more attention, then they'll really start rising. Because CRMD has really good fundamentals. But to answer your question of why has it been selling off and so forth, well, healthcare hasn't been getting a lot of capital. It's just been kind of the AI show and some crypto, and maybe a couple other areas are out there. The other space is like software, like CRM. The stock is really beaten down. Adobe beaten down. DocuSign been selling off. It's like investors forgot that there's software companies out there that make a lot of money. But that's the market for you. We got to take advantage of the market's irrational behavior, whether it irrationally discount stocks. That's an opportunity for us. And we just got to find it, do the homework, and invest. Yep, in the long term, the market's a weighing machine, and it's going to weigh these profits. It's going to be like, hey, this company produces all that cash and profit. It's worth more. Have you looked at any in Den sector? What's the Den sector? I'm not familiar with the Den sector. Yeah. Here's the sectors I'm familiar with. So maybe, do you have any in dense sector? Yeah. Don't have it. Or I don't understand the question, I should say. All right. So we'll close that guy out. Good questions, man. We dug deep on a couple stocks. They look good. Let's keep going. And if anybody else wants a stock, so we got some members out there. If you'd like me to look at another stock, just pop it in there. If you're not a member, just a $5 super chat and we'll take a look. All right, moving along. I wanted to take a look at, when and den, places where you eat out. Now I don't like restaurants. But let me go over some stocks that announced, and these guys announced today. Sea Limited, and these guys, they did a lot of NFT stuff. They do a lot of crypto stuff. They were red hot, then they sold off drastically. But over the 1 year, really nice gains. And when you look at the fundamentals, it's like, man, how did I miss this one? But I did. Market cap's 103 billion. The revenue $19 billion. Man, these guys are in Singapore. Okay. And when we look at their revenue growth, this is really good revenue growth, 34%. Quarterly, 38%. So the revenue growth looks fantastic. They're in the crypto space. This is a real crypto company. It's not one of these, hey, we decided to start selling Bitcoin on our platform. And 45% margins, not the best margins I've ever seen. They are expanding them. They do have pretty good free cash flow margin of 22%. And in my head, I think this business could be worth 120 billion or so. So they are slightly discounted. And the stock went up a lot today. Showing up a day late on this one. But this one has performed really well for the year to date, for the 1 year. And it's probably, you look at the volatility that this stock has seen, this one will probably sell off. And I'm going to put this guy on my watch list. I'll do my homework on my own, but I'm gonna make sure this thing's on my watch list. CoreWeave, this one's selling off by 10%. Here's why. And I think Juicy, you brought up, it was like Nebius. Is it Nebius? Yeah. So Nebius Group and CoreWeave are similar. You brought this up in our member call this morning. And these guys are doing really well. They're hyperscaler, really set up to do infrastructure for AI plays, building out large language models, doing the workloads that have a high performance need. So we talked about this guy, and now we're going to talk about CoreWeave. And early on, I shared, CoreWeave's only been publicly traded for a little bit. And when they announced, they said, hey, I'm a little skeptical. And then the stock really took off, and it's really sold off a little bit. And now it's selling off 10%. It's a $71 billion market cap company, $2.7 billion of revenue. So you're paying about 25 times revenue. That's a little expensive. They don't make money yet. They are growing. They're growing nicely. And these guys grew, but their margins are not the best. So free cash flow, they're burning cash. They're putting more equipment in the data center to operate. And operating margins are positive. This is not the latest and greatest. I was looking at their earnings report earlier that I'll kind of reference by memory. Their profitability is the part that is making investors think twice. The other thing that I would be careful with is they have debt. Okay. So they've taken on debt to buy the equipment they need. Some of the debt is from Nvidia. Nvidia would like them to buy as much equipment as they can probably handle, which is understandable. When we go debt to EBITDA, it's a 6. That's really high. Shouldn't be over 3. I like 3 or less debt to EBITDA. This is going to take a while for them to be able to pay off that debt. Now, they can fast track paying off the debt if they issued out shares. And I wonder if they did issue out shares again. So, shares outstanding. Yeah, they're issuing out some shares. Not too bad. They IPO'd just recently, so they haven't issued out many shares. So this one here, the way I'm trading this hyperscale business is while they grow, I think these businesses, their stock prices could go up quite nicely. And this one's in Europe, if I recall. Was it the Netherlands? They were in the Netherlands. Yeah. And this one's probably the fundamentals are better than CoreWeave. CoreWeave's a higher market cap. And what I would be concerned as an investor is, okay, right now there's a lot of demand for high performance computing. But what if that demand dries up? The big hyperscale businesses are Amazon with AWS, Microsoft with Azure, Google Cloud. Those businesses are going to take what companies spend in a, let's call it a down market for hyperscale services. So if there's any kind of downturn in this whole AI build out and so forth, these guys are really going to suffer. And then they're carrying that debt. That's a double negative. That's what I've always thought. Looking at this business, I'm like, I'd rather not own this business. I own Amazon. I own Google. I've got hyperscalers covered. I don't need to put myself out there with these guys. What makes this business work is they buy the best equipment available, NVIDIA, GPUs, and everything else that should go in that data center to have high performance. But they don't intrinsically have something that's really desirable. It's not like they have a patent on, hey, we can offer this technology. So pretty much like NVIDIA, they have their GPU technology. They're the only ones that can offer it. So they become really desirable. CoreWeave, that's not the case. CoreWeave can have a data center with the equipment that they decide to put in there. Nebius can have a data center with the equipment because NVIDIA is happy to sell their equipment to anybody. They're semiconductors. AWS, Microsoft Azure, Google Cloud, IBM. I mean, we got a lot of competitors lining up. So it could be a crowded market, and that's what I don't like about this. There's no barrier of entry. There's data center companies, that are big, powerful, strong, have relationships with their customers, have a better network power than CoreWeave. And that's why I've, haven't invested in these guys. So Nebius looked better. And as mentioned this morning, we looked at this stock before. Man, look at that. 172%. Wow. 300%. Jeez. Beautiful. Take the money. Good job on that one. All right. So CoreWeave selling off. See what happens tomorrow. Circle. This is the stablecoin company. I'd rather own Coinbase, but let's just go over Circle. Circle is kind of a one-trick pony. One product company, one particular business model. And for the 1 year, they just IPO'd, so I don't think the 1 year matters. I don't even think year to date matters. So they IPO'd and they're getting back to, they were IPO'd at $83 a share. They ramped up. This was a big surprise. It's like, God, it's just stable coins. They don't make a lot of money, but they exploded. Revenue is growing nicely. has a good linear, component to it. Looks good. They do cash flow. See the gross margins, they're not humongous, but it's more of a platform play. They create the stable coin and then people use it or businesses use it. Free cash flow at 300 million. That's really good. If they're growing nicely, maybe we get to 12 billion, 15 billion in market cap value, and they're way up there at 37. So I'd rather own Coinbase. I think Coinbase has a better diversified business and actually has a stable coin business as well. But they also have other businesses, and I like that. And I think Coinbase is ahead of these guys. So these guys are selling off a little bit in after hours. This one is an IPO. The IPO market's gotten really, really active. And boy, people are eager to buy these IPOs. This IPO is, I was surprised because this is kind of a niche company in crypto. It's not like, just imagine if OpenAI IPOs, man, that thing's going to break the internet. But these guys are like, okay, it's a niche company. I'm surprised that it's done that well. All right, so Juicy, you got 450 shares, nice. Plus 46 so far, nice. Nice work there. So this stock here, we reviewed this stock. We reviewed it last week, and I came to the conclusion that it was discounted like 36%. I was going to watch it, and boy, watching a fireworks show. They announced, now this isn't a perfect company, right? It is a small cap. They do software. Provides AI-powered solutions in the U.S., United Kingdom, internationally. Deal Cloud, Relationship Cloud, direct relationships. So this company focuses on businesses like law firms, accounting firms, and they sell what I would call as a back office application. So they can manage their business. They get customers, they build the customers through this application. So it's a logical business. One of the concerns I had when we evaluated is, well, their addressable market's going to be limited to those industries. But they're small and they can really grow into that space. They're 483 million. They're growing nicely, 17%. Most recent quarter, they showed a little bit of an acceleration on growth. That looks really good. And gross profits are going to be good, 74%. Very good. They do have free cash flow. Very good. Look how they've grown that free cash flow. This is the software as a service business. You get a customer to buy your software. It's a profitable business because you write the software once, you can have 1 million customers. They're using the same code base. You only had to write it once, but you get 1 million customers. Voila. This is how you generate a lot of cash. It's no accident that Microsoft is the second most valuable company on the planet. It's no surprise that a lot of software companies are worth a lot of money because of this effect. Once they get their business to scale, they make a lot of money and generate a lot of cash. This business is right there. I valued it last week, said it was 36% discount. I updated my valuation based on what we got in their earnings report, and it got even better. Their earnings were good, really defined that they're a business that's here to stay, looks good. And I think I have the valuation ready. Now it's discounted by 31%. When we looked at it last week, I was only able to get to a free cash flow valuation, which ended up being 36 or 37. Now they have earnings per share that they expect in the new year. So I'm able to use that number, and collectively it's a 31% discount. So this one looks like a good watch stock. I think I'm already watching it, but I didn't jump into it last week. That's okay, because it could have gone the other way. but they announced good earnings, and now it's up nearly 25% in one evening. If you own Intapp, congratulations. It's pretty cool that on the live stream, we get a lot of really good stock suggestions, like Intapp, and A-Lab came out of a live stream. A bunch of really good stocks come out of the live stream. We take a look at them, beat them up, and then some of them becomes really, really good winners. This one here, I'm going to watch it. I'm not going to buy on a day when it goes up 25%, but I think it's a business that's here to stay. We'll see. We will see. Michael Anthony, what happened to DSP? DSP's revenue did not grow fast enough. And I did a whole video on it today. Watch my video. The video really points out exactly what happened. I can give you the synopsis, which is DSP is in the ad tech space. They present ads, for the companies that use the software, they use the platform, and they advertise on Netflix, YouTube, and so forth. And their revenue, although it grew, it started to slow down, 18% versus 32. Now, if you kind of take that on its own, you're like, well, that's not the worst case scenario, except that within their space, in the video that I put together and that I just released today, it looked at AppLovin, The Trade Desk, Viant, and Zeta. And we looked at Zeta on the live stream like 2 weeks ago or last week. And AppLovin is much larger, way larger, and they're growing at 77%. So a smaller business not being able to grow faster than the big company in the space, it's not a good sign. It's a sign that AppLovin has something that's far superior from a software perspective. And that's what happened to Viant. The lack of growth is what is scaring away investors. They're like, man, you guys are tiny compared to AppLovin. You should be growing faster. If you can't be relevant, then you're going to be in trouble. I do not own, good to see you, Brandon. I do not own Viant. I have owned it in the past, but decided to sell it and only owned it for a little bit. I owned AppLovin, and that one I regret selling. AppLovin's done terrific. And AppLovin was part of a short seller had a negative story about them, and the stock did sell off on that news. But boy, AppLovin has the last laugh on that one. I bet you the short seller is just getting slammed. So AppLovin was a huge winner. Man, I should have kept that one. I found it, I invested in it, and I got out too early. Lesson learned. Lesson learned. Maybe that's the lesson I learned, and maybe I could stick to A-Lab and Robinhood and all the other stocks that are just flourishing. Again, good to see you, Brandon. Very good to see you. Thanks for joining. Let me know if there's a stock you had in mind for me to look at. All right, so we've been rolling for about an hour and 20 minutes or so. We've covered the stocks that I wanted to cover that announced. We are in good shape there. What else is interesting to talk about? So just real quick, have I lifted gap? I have. I'm not a big fan of apparel. It's just a tough business, man. It could be like a short-term gainer, but that's about it. So as we look at the last month for sectors, communication services, Meta, Google, Netflix, they're way up there. Technology's way up there, of course. NVIDIA, Microsoft. Look at the utility stocks. These things, historically, I've not invested in utility stocks because I just don't think they're good investments. But boy, everybody, or I should say the story that power is going to be a big necessity is really driven up the stock prices for utilities. Interesting. Material stocks are beginning to work. And I did a member-only video on material stocks showing the details. They're beginning to work, and I think that's going to have some legs. Consumer discretionary, that's right, middle of the road. Consumer staples had a bad day today because everything else had a great day. And then real estate. If we have lower interest rates, we may see real estate do a lot better. And then here's healthcare, not getting any love. Energy is way down here because oil prices are down. The energy commodities are just not getting a high price. That's just the way it goes. These guys go where the energy prices go. So that's what's going on from a sector perspective. So what earnings are coming up tomorrow? Cisco, one of the original tech companies, Cisco. Elbit, Coherent. I forgot what Coherent does. They're tech. Performance Food Group. Santec, Brinker. And Brinker, I think, is it's a food company. Yeah. A restaurant company. DLocal came up. DLO came up. It's a payment processor, and we covered it this morning on the member call. We'll see how they announce tomorrow. Madison Square Garden. I think they're the owners of the Knicks, if I'm not mistaken. But I would have thought the Knicks are worth more than that. Maybe I'm wrong about that. I thought the Madison Square Garden Entertainment Company owned the Knicks, but for sure they own the arena. All right. What else is out there tomorrow? I don't see anything else. Everything else is small. All right. So that's what's going to happen tomorrow. Nothing is like the volume of earnings for the last 3 weeks have just been really hard to keep up with, but we lived through it just barely. And now we get to slow down a little bit, like a big earnings, maybe 2, and then a bunch of little ones. Here's New Holdings. I own New Holdings on Thursday. Got Applied Materials. This is within the semiconductor complex or ecosystem. They provide materials into semiconductors. They don't necessarily manufacture or design. They don't design semiconductors and then produce them. Deere and Company. That'll be interesting. See where they're going. And I think that's it. Those are the ones that I'm interested in. So it'll be a little bit of like 1, maybe 2 big earnings, and that's it. All right. So, all right. So Lyft, I think I mentioned earlier in Lyft. Lyft could be a short-term gainer, but Uber's won the war on that one. And David Knight, I own New Holdings. Yeah, we'll see, man. And, Brazil is a little unpredictable right now. It seems like things that are touching Brazil are going down. Mercado Libre, they had a hard time making money in Brazil, and their stock sold off. So I don't know if there's any connection to New Holdings, but we'll see. We will see on Thursday. It'd be good to get some more information there. I've been kind of, careful with my New Holdings position, and I'll be eager to read their financials and see what they had to release, what they had to say about the business. All right, so we've been going an hour and a half. It's been a good live stream. Thanks everybody. We had a lot of people join. Thank you so much for spending part of your afternoon, evening with me. And I'm going to try to stream tomorrow morning, and I'm also going to try to stream in the evening, similar to this time for the rest of the week. So if you guys want to check in, that'd be great. Be great to have you. Thanks so much for the questions. And you're going to watch the PAGS dip, huh? PAGS is a payment processor, right? PagSeguro, yeah. Down in Latin America. All right. And this one's up 4% year to date, up 42%. Wow, real good. It had been sold off. Yeah, I remember looking at this one. And they're going to announce on August 19th. Oh, Interesting. I'll keep an eye out for that. So in the morning, I'm going to stream tomorrow at 9 a.m. Eastern, 6 a.m. Pacific, if you want to tune in. Thanks for asking, Michael Anthony. Yeah, thanks. Have a good night. And thanks for the ideas. The small caps are really interesting to dissect, and I'm going to watch them. All right, everybody. Have a good night. Thanks for tuning in.